Okay, folks, let's get started. How's the mystery project coming? It's coming? Good. What I want to do today actually is finish that discussion we just got started on private company valuation. In fact, as I mentioned, the last thing I said on Wednesday before I closed off this section, before I ended class, was how you value a private company will depend on who you're doing it for and why you're doing it. Okay, the reason I said it that way is when we valued publicly traded companies, we never asked those questions, right? We valued a publicly traded company in a sense for the market. We kind of took it for granted that there's only one value for a publicly traded company. Private companies, how you approach valuation can be different depending on what the valuation is for. In fact, I'm going to classify private company valuations into three groups. I'm going to start off with the most difficult, the messiest group, which is private to private transactions. You know what I mean by private transaction, right? I'll give you an example. I took my youngest into the dentist yesterday, and the guy is thinking about retiring. He's going to sell his entire practice to a new dentist. That's a private to private transaction. One dentist selling to another dentist, you're selling a practice. 90% of all private company valuations, if they're for transactions, are for private to private transactions. And many of them are really small businesses. A plumber selling his business. Today we're going to look at a restaurant being sold, okay? Private to private. Every conceivable issue in private company valuation is going to rise to the surface when you do a private to private valuation. Second set of valuations I'm going to look at are private to public valuations. You have a private business that you're selling to a publicly traded company. We're going to look at what's different. It's not that different from traditional valuations. We look at the practical implications of doing that. And the third set of valuations, I'm going to look at private companies that are going public. Remember, this is accessible only to a very small subset of private businesses. You've got to be a really successful private business to kind of get to the stage where you're thinking about going public. Let's think about both the transactional issues and the valuation issues associated with that set of valuations. Let's start with private to private valuations. To me, there are three things that make private to private transactions difficult to value. The first is neither the buyer nor the seller is diversified. So the dentist who's selling his practice has pretty much his entire wealth tied up in the practice. The young dentist who will be buying the practice is going to be pretty much in the same position. So both sides of the transaction are undiversified. They've got their entire wealth tied up in the business. We've got to deal with that. Second, the investment is illiquid. So if you buy a dental practice, it's not like you can change your mind tomorrow, hit sell on E-Trade, and it's going to be gone. It's going to be much more difficult if you have buyer's regret to actually get rid of what you bought. And third, and this is something we tend to forget, because many of these businesses have a personal component to them, and the person selling you the business is going to leave tomorrow, you've got to worry about what the consequences are. You know what I'm talking about, right? If this dentist leaves, what your worry is, as a young dentist coming in, is will the people who used to come into the practice continue to come in? Because you could pay for a lucrative practice based on what they made last year. You can come in tomorrow and everybody's left because they came for the dentist, not for the practice itself. So somewhere in the valuation, we've got to factor that in. So here's what I'm going to do. I'm going to take an example. Let's assume that I'm a French chef and you're an investment bank. You want to switch sides? I don't care, right? Okay. I'm thinking of selling my restaurant. I've built up this restaurant. It's a successful restaurant. I'm thinking of selling the restaurant. You're tired of being an investment bank. You aren't even one yet, but you're tired already. You know, this is too much work. I want to get out of this business. So you take your entire savings and you decide to buy the restaurant. Let me add, though, that you don't know how to cook. Your version of dinner is pick up the phone, call, somebody will deliver the food, but this doesn't work. So you know what I'm saying, right? I will leave and you will now be running the restaurant. You go into the kitchen, nobody's coming into the restaurant ever again. So we've got to factor that in somewhere, right? You have access to the most recent financial statements, and based on last year's income statement, the restaurant looked pretty good. They made about $1.2 million in revenues and $400,000 in pre-tax operating, at least based on the financial statements I've developed as a chef. So let me show you those financial statements, and let's think about some of the issues here. So these are the financial statements I developed as the chef getting ready to sell the restaurant. So you can see revenues have gone from 800 to 1.1 to 1.2 million. But before you start building that growth in, I also have to tell you that we're operating at full capacity now. Every table is taken every day. Okay? Operating lease expense, my biggest debt is actually in the form of leases. The space I have for the restaurant, $120,000 every year, the 12 years left on the lease. I'm treating it as an operating expense because that's what my accountant told me I could do. It's an operating lease expense. Now, we might have other thoughts about that, but we'll deal with that later. I have wages, and the wages have gone from $180,000 to $200,000. They've kind of leveled off there, but I also have to add that the chef does not draw his salary. Why? Because all the money that's left over comes to him anyway, so he hasn't bothered putting a salary. There's the raw material, other operating expenses, operating income, taxes, net income. You're saying, well, how come there are no interest expenses? The only debt he has is leases. Those leases are being treated as operating expenses. So that's what you're looking at as a potential buyer. Okay? So let's look at the issues in this valuation. Let's go step by step. Let's start off with the first step. We need, or you need, a discount rate to value this business. Okay? When you try to estimate a discount rate for a publicly traded company, you tend to draw on public information, prices to get betas, ratings to get cost of debt. You weight them by market values to come up with the cost of capital. As a private business, you don't have any past prices, and you have no market value weights. So already you can see you're in the hole, right? Coming up with numbers is going to be a lot more difficult as a private business. But we've actually established a template, even with publicly traded companies, that I think we can transport here to estimate the beta. So here's the first step. There's no market price, no regression, but we don't care, right? We can do a bottom-up beta. I went and looked up publicly traded restaurants, and I did have a little queasiness about doing this, because when you look at the list of publicly traded restaurants, the types of firms that come through are not exactly five-star restaurants. They're Burger King, McDonald's, etc. So in fact, I considered using a different set of comparable firms. You could argue that maybe I should use the betas of special retailers, somebody who sells to a more upscale crowd, more discretionary. So that's something to consider here, but I stuck with this simply because I wanted to keep my life simple. The unlevered beta across those 75 publicly traded restaurants was 0.86. I'm going to start off with that as my unlevered beta for this restaurant. So far, it's looking just like a publicly traded company. But here's a problem that we have to deal with. When you use betas to come up with the cost of equity, you're focusing only on the risk that cannot be diversified away, right? It's market risk. With a publicly traded company, what do we assume happens to the rest of the risk? The company doesn't diversify it away, but investors in the company are diversified, so they get rid of that risk. So to kind of give you a visual picture, if you start off with a restaurant with 100 units of risk, in a publicly traded firm, we're assuming that 80 units of the risk get diversified away in a portfolio. So we focus only on the 20 units that are market risk, and the market beta we come up with reflects that market risk. So let's do a little algebra. You're potentially buying this restaurant, right? You're looking at risk. How many units of risk do you see? You see 100 units of risk. You're not diversified. Your entire wealth is going to be tied up in this restaurant. So already intuitively you can see that if you take that beta, 0.86, even if it's the right beta, it's not going to capture the risk you're exposed to because it captures only the 20% of the risk that is market risk. So at least algebraically you can see what you'd like to do, right? You'd like to scale up your beta to reflect the other 80 units of risk that you're exposed to because you're not diversified. That is the idea I had when I came up with the total beta, because it's something that I always found troubling in private company valuation, is that people added an arbitrary premium on to the cost of equity for private companies with the right intuition. They said private companies should have higher cost of equity, but we don't know how to come up with that cost of equity, so we're going to take a public cost of equity and add 10%, which strikes me as not a very good way of doing this. Okay? So here's how I went from a market beta to a total beta. I revisited those regressions, those beta regressions for the publicly traded companies from which I got the market beta. I looked up a number. Every time you run a regression, stock returns against the market returns, you get a beta, you get an R squared, right? The R squared in that regression tells you the proportion of the variance in these stocks that is explained by the market. The average R squareds across, in this case, I use the high-end retailers because that's basically what I'm going to end up with using for my final beta. Okay? The high-end retailers, 25%. So somewhere along the way, did I switch from 0.8? Okay, that's good. I did switch to 1.18. Good. So I did switch to 1.18. So that's the unlevered beta for retailers. Switch from restaurants, retailers. I looked across the retailers. The average R squared across the retailers was 25%. The 1.18 that I ended up with as a beta for those retailers reflects only the market risk in these companies. So I took the 1.18 and divided by the square root of the r squared. What's the square root of the r squared? Statistically, what do you end up with if you take the square root of the r squared? R, I know. But what's a statistical? It's actually the correlation, right? The r squared is the proportion of the variation that is variance that is explained by the market. The correlation is the proportion of the standard deviation that is explained by the market. That's right. They both measure the same thing. One measures variance. R squared measures it goes with variance. Correlation goes with standard deviation. You're saying, why did you switch from r squared to correlation? Because betas are a standard deviation measure. We don't even see this happening, but it happens behind the surface. When you run a regression, you get the slope of the line. That beta that you're getting is actually a function of the standard deviation of the stock and the standard deviation of the market. So we're kind of staying consistent. We're taking the beta, which is a standard deviation measure. We're dividing by the correlation, which is a standard deviation measure. What I end up with, I call it total beta, just to contrast from the market beta. So when people talk about beta, they're talking about market beta. I'm taking that beta and adjusting it for all the other risk you're now exposed to because you're not diversified. So you can already see what's going to drive the total beta, right? First, it's going to depend on the market beta. The higher that number, the higher the total beta. It's also going to depend upon where the risk in that sector comes from. Does it come from the market? Does it come from the firm? The more risk that is firm-specific, the higher the total beta is going to be relative to the market beta. When I do my cost of equity for this restaurant, I'm going to use 2.36 as my beta to come up, as my unlevered beta to come up with my cost of equity. Because my rationale is this investor is not diversified. He basically sees all risk, therefore he should demand a higher cost of equity. So there are two components to that. One is the intuition as to why I'm doing it. The other is the mechanics. Okay? I want to make sure you get both parts of that. Are there any questions on either half of that? Okay? On either the intuition as to why we're doing it and the mechanics? Yes, please.
This question, I don't know if it's exactly related to this, but in private equity, would you also use total beta? Because then you are diversified.
Okay, that's actually a good question. We have two extremes here. The publicly traded company with diversified investors, we go to market beta, right? With a private-to-private transaction where you're completely undiversified, you go with total beta. The question Louis is asking is, what happens if you have somebody who's not fully diversified, but is not fully undiversified either, which is where a private equity investor might end up or a venture capitalist might end up. So we can see the answer lies somewhere between the 1.18 and 2.36, right? But where should it, how would I come up with that? Where in that range I would put the beta? What would I need to look at? I'd have to find out what's in this private equity investor's portfolio, right? Once I find out what's in that portfolio, I'm going to look at the correlation between that portfolio and the market. Let's say you have a fairly diversified portfolio. As you get diversified, what's going to happen to the correlation between your portfolio and the market? It's going to start climbing towards 1, right? So if you're a private equity investor with 50 different investments in different sectors, you might end up with a correlation of 0.9, and your beta might be only 1.26. If you're a really small private equity investor who buys only 3 positions in one sector, you might end up with a correlation close to 0.5 and a beta close to 2.36. Okay? So where you end up will depend upon the correlation between your portfolio as an investor and the market, which will determine how much of an adjustment to the beta that I will make. Now, as a private equity investor, you want a lower beta or a higher beta? You want a lower beta. Even though you might pay based on a higher beta, you want a lower beta. So you can already see that in the comparative market of private equity, it's better to be a diversified private equity investor than an undiversified private equity investor. So does this mean small private equity investors are sunk? Is there a way that you could be a small private equity investor, not be diversified in your positions, and still end up being able to use a market beta? Why do publicly traded companies get away using a market beta? Because, not because the company is diversified, right, but because investors in the company are diversified. I've given you a way out. You're a private equity fund. You can't get diversified on your own because you don't have enough resources. So what could you do? What did Blackstone do? They went public themselves. That's all you need, right? You don't need to be diversified. All you need is investors in your outfit have to be diversified. So I'll make a prediction. This is going to, I mean, the crisis we're having right now is going to shake out the private equity business. You're going to see those private equity funds that survive be larger than the ones that came into this business, and more of them will be publicly traded than they were historically. It will require some oversight and all the other costs of going public, but you face too much of a penalty if you're not diversified in this game, because you then have a higher cost of equity. You can't compete against somebody else for the same company because they can pay a higher price than you because they see less risk in the same transaction. Any other questions? Okay. So to get a total beta, you're going to do exactly what you did for a bottom-up beta for a publicly traded company. You're just going to add this one extra layer of looking up the correlation. Those of you who have checked out on my website on the updated data, I have the betas by sector. I also have total betas by sector, right? So if you go in and look at, you can actually look up the total beta by sector. If you're a private business owner looking for a cost of equity, that's the beta you'd be using. But don't use it for a publicly traded company. It wouldn't make sense. Yes?
If I have a private company and I know the buyer is diversified, so why would I?
Hang on. How do you know? In this case, you have a restaurant, you have a buyer. How do you know the buyer is not diversified? If you know the buyer is diversified. Let's hold off on that question. If you know the buyer is diversified, that's a different game, right? This case, you have two undiversified people playing against each other. We'll ask what will happen if you can expand the playing field and get a diversified investor into the bidding war. How do you price and change? You can already see what's going to happen. You're going to start demanding a higher price because you're going to base it on the best potential bidder. You don't base the price on what you see as risk. You base it on what the buyer sees as risk. Any other questions? So in this case, 2.36 is going to be my unlevered beta. Yes?
How did you find the R-squared for sectors?
Same way I got betas. What did I do? I took random regressions. So the betas came from regressions, right?
No, but let's say you have 100 betas, 100 companies.
Yeah, and you have 100 R-squareds.
Yeah, 100 R-squared.
Take the average.
Average of R-squared or average of
Would there be a statistical difference? I have to think about it. I actually took the average of the R-squareds and took the square root. Would it have made a difference taking the square root first and averaging? I just took the average first. Right? I don't think from a finance standpoint there's a difference. Statistically there might be a difference depending on the noise and the R-squared estimates, I guess. Okay. Any other questions? Where? Oh, there, sorry.
You know, when you're doing a bottom-up data,
Yeah. I'm still staying with the same idea, right? The business risk is still the risk of the private business. The only difference is I'm now scaling up the risk to reflect the fact that I'm counting all risk, not market risk. So if you're buying a chemical company, I'm still saying use the beta of a chemical company. Steel company, use the beta of a steel company. The only difference here is whether you're going to count just the market risk, which is what we do in a public-to-public transaction, or total risk, which is what we're doing. So the argument is not about whose business risk to use, but what portion of that risk we should count into the cost of equity. Okay. Do you see what I'm saying? You should be using an investment banking beta to value the restaurant, even though you're an investment banker, right? You would still use a restaurant beta. The question is whether to scale up the beta or not.
But in that case, we'll both value the company the same, right?
Yeah, because we're both undiversified. And I think his question is, what if the buyer is a diversified buyer and the seller is not? Because then we could be looking at the same business and seeing different estimates of value, right? We'll talk about that. Because in a sense, that's, I think, when you have to start bargaining. Because you as a potential buyer have an advantage here, right? You can pay me a premium on what I think is a fair value and a discount on what you think is fair value. This is the definition of a good deal. We both walk away happy, right? So you can already see if you're starting a business of acquisitions, this is one thing you can exploit as a diversified private equity investor, is you can approach private sellers, offer them premiums on what they think their business is worth, and still walk away with a substantial premium. Right? So, yes, please.
Definition of total unlevered beta is 100% paid by premiums.
Exactly, exactly. So it's the other extreme. So the 20 is one extreme, the 100 is the other extreme. No, all the others are intermediate between the 20 and the 100. Once we get the unlevered beta in a publicly traded company, we lever the beta up using a debt-to-equity ratio, right? And the debt-to-equity ratio is a market debt-to-equity ratio. And here again, we run into a roadblock. There's no market debt. There's no market equity. There are three potential solutions, but I'm going to list the first two, and I'll talk about the third one because it's a little messy. One is to assume that the debt-to-equity ratio for the firm is similar to the debt-to-equity ratio of publicly traded companies in that business. This is kind of cop-out, right? Basically saying, I don't know what a market debt and a market equity is for a private business, but I know what it is for a publicly traded firm, and I'm going to use that. Okay? The second is to use is to actually use your own valuation, because you're going to be doing a valuation to come up with the weights for the debt and equity. We talked a little bit about this in the context of publicly traded companies because this seems like a circular logic problem, right? You need the value to come up with the cost, the weights, and the weights to come up with the value. Normally, I would say don't even go down the road, but with Excel in the iteration box, you can actually use your own estimates of debt and equity to essentially come up with the weights for the cost of capital and value the business. The third is you can pick up the phone and call the owner and say, what's your target debt-to-equity ratios? Pathway I would not recommend because the answers you get will either be, or a number that actually has no meaning at all. Okay? But I've seen people try it because it's a cop-out. You gave me the debt-to-equity ratio. I just used it. Don't pick on me. But if you think in practical terms, you can either use the industry average or you can use this iterative process to kind of back into the weights. I decided to take the easy way out. I use the industry average debt-to-equity ratio, but I use the industry average debt-to-equity ratio of the restaurants. As opposed to what did I use for the bottom-up beta? I use retailing for my unlevered beta risk, but for the leverage, I'm going back to a restaurant leverage because he runs his restaurant like a restaurant. He leases the store. So your financing decisions are driven by the fact that you're in the restaurant business with its special needs. But your business risk is being driven by, hey, what kind of customers do you cater to? It sounds like I'm being inconsistent, and maybe I am, but I'm picking and choosing my fights. There's no reason. Consistency is going to drive you crazy in valuation. It's like people saying, I got all my numbers from the September 2008 annual report, and that's what I'm going to stick with come hell or high water. It's a bad way to do a valuation. The idea here is for each input, you revisit basics and say, what am I going to use? So that's what I used. In this case, using that debt-to-equity ratio and the marginal tax rate gives me a levered beta of 2.56 and a cost of equity of 14.5%. Much higher than a publicly traded restaurant or retail firm, but reflecting the fact that you as the potential buyer are not diversified. Cost of equity, the risk premium, so it's not the risk-free rate. I'm not messing with the risk premium. The risk premium is staying what I use for other publicly traded companies. What's changing is the beta. Don't double weight risk by then pushing up the risk premium, saying this is a private business, and pushing up the cost of equity a second time. The beta is taking care of it. Last step is I need a cost of capital. Okay? The only debt they have is leases. So basically the first step is I need a cost of debt to take the present value of the leases. And here I ran into a bit of a problem. First problem is the company doesn't have an actual rating, right? It's a small business, a restaurant. You're not going to go to S&P or Moody's and get it, so it's not going to work. When you don't have a rating, what was our fallback mechanism? We used the interest coverage ratio to come up with a synthetic rating, but this company has no conventional debt, so there's no conventional interest expenses, which means there is no conventional interest coverage ratio. So I cheated. Here's what I did. I took the operating income and I divided by the lease expense, acting as if the entire lease expense was an interest expense. It's cheating because even if I capitalize leases and make them debt, only a portion of that is interest expense. The rest is all principal repaid. But since I don't have a starting point, I said I might as well start there. So I used that, came up with an interest coverage ratio, came up with a rating and a default spread based on that interest coverage ratio. If you're uncomfortable treating the entire lease expense as an interest expense, then again, you can set up the iterative process, right? Use the rating, come up with the present value, come up with an interest expense, do it until again you converge. But it's probably not worth the effort here. I'll probably end up with BBB when I'm done. It'll be a little higher, but it's not going to make an immense difference. So I ended up with a 7.5% pre-tax cost of debt, 4.5% after-tax cost of debt. So my beta is a bottom-up, not a market beta, but a total beta. The cost of debt, I'm following the conventional practice. With some private companies, especially really small ones, you could argue that when a bank lends to them, The bank will charge them 7.5% plus an extra 1.5%. Why? Because they're small businesses. I mean, we're getting these default spreads by looking at publicly traded firms, and even the smallest publicly traded firm is going to be far larger than this business. So if you feel that you have to add an extra spread on to reflect the fact that it's a really small business, there's no harm doing that, in which case your cost of debt might be 8.5% instead of 7.5%. And you're going to use that to come up with the cost of capital. In this case, the cost of capital I ended up with, based on the fact that I have only leases as debt. The present value of the leases was 100 million. I'm sorry, 14.33 million. Using only the leases as debt, I ended up with a cost of capital of 13.25%. Took a lot more work to get there because I can't take any of the numbers for granted. There's no market value, but don't fall into the trap of saying, I can't do it, therefore let me do whatever I want. Let me make up a discount rate, because that's not an effect. I mean, at least here we can debate the numbers and say, should I have used restaurants or retail firms? Should I have used this debt to equity or the other one? We're still working with the same mechanics. Any questions on the cost of capital for private business? Second step. I took a look at that financial statement, or you took a look at the financial statement I gave you. Right? Let's revisit that statement and let's try to see if that statement has to be modified or adjusted for anything. First thing I did was, remember the lease expense that you showed me, 120,000? I decided that wasn't an operating expense, it's a financial expense. Something we did with publicly traded firms, so I'm staying true to that. So what happens is I've taken the lease expense up, but I've replaced that with an interest expense which reflects the interest rate times the present value of the leases. So you see an interest expense showing up below the operating income line, reflecting my readjustment of leases. Right? For the wages, I added another 150,000. You know why, right? I'm selling you the business. I'm the French chef. I'm gone tomorrow. You now have a restaurant, a really nice restaurant, but you have no chef. A restaurant without a chef is not going to stay a restaurant for very long. Now, you could go to the campus eatery and hire the cook there, but you won't have a restaurant for long either, right? I mean, they make their versions of every kind of food under the sun, and none of them is done right. They make Thai food, they make Chinese food, they make Singapore noodles, they make soup, they make but everything. So, but you can say the guy asked for me only 25,000. I can save some money. You can, but this is a top-notch restaurant. You're going to pay a lot of money. I don't know what the going rate for chefs is, but 150,000 I thought was something you might need to pay, at least to be competitive. Okay? So I added 150,000 to the wages. Essentially, that's almost like pricing. If I'm a top French chef, pricing my time and putting it in there, right? The rest pretty much stay together, but you can see that my operating income, instead of being 400 million, is now down to 370 million. My net income, instead of being 240 million, is now down to 180 million. So the big adjustments, one was a standard adjustment, leases becoming financial expenses. The other is the wage for the chef. Any questions on that? Third, I looked at what will happen tomorrow when the chef leaves. Right? So I'm going to sell you the restaurant. The restaurant's at full capacity right now, right? It's got a great reputation. It's been written up in the New York Times. People are coming. People are going to see a news story tomorrow that I'm leaving. Presumably, some of the people who came to this restaurant came not because of the name of the restaurant, but because of the name of the chef. I'm going to make an estimate that tomorrow when you take over this restaurant, even if you replace me with a new chef, a new top-notch chef that you're paying $150,000, you're going to lose 20% of your revenues. I don't even know how you'd estimate this. Maybe you'd stand outside the restaurant the day before you buy it and as customers come out, you say, will you come back to this restaurant tomorrow if the chef leaves and the new guy? I mean, but you better get some sense of this. You can't just assume that everybody's going to keep coming back tomorrow if the chef leaves. So I'm taking 20% off, which basically means my operating income with the existing chef with 370,000, assuming that 20% of that operating income is going to be gone without the chef, I'm going to be using operating income of 296,000. I can see what you're doing, right? I'm trying to sell you the business. You're knocking 20% off the operating income. What's that going to do to my value? It's going to make it lower, right? Is there something I can do to counter this as a potential seller?
Hiring the new chef, what if that will account for that extra 20%?
Well, I mean, with my ego, I'm probably saying no matter who you hire, he's not going to be as good as me. So presumably there's a name effect, right? I mean, so what can I do to kind of ease the impact? Because I'm losing 20% of my restaurant's value because you look down the road and you're worried about. which is me. So basically, I'm selling you the business. I might say, look, I'll ease the transition here. For the next 3 years, I will stay on, if not as chef, kind of with the existing chef. I know it's taking out of my time. It might not even be the next 3 years, maybe in the next 6 months. This often happens in personal businesses. The old dentist, actually, when he sells his practice, will stay on for a few months with the new business to kind of ease the transition. He's not doing it out of the goodness of his heart. Maybe he is, but that's not the prime factor. He's doing it because if he doesn't do it, he's worried about how much value he will lose because people start knocking off this lost sales part. The other thing you better make sure I do before I sell you this restaurant is what? I sell you this restaurant, I take your money. What might I do with that money? Start a restaurant next door to you, right? So the second thing you're probably going to do is you're going to have a no competition clause in there, because if you don't have it, who knows what I could do with the money? I could start the restaurant, next thing you know, all my customers are coming over to my next door, and you're sitting there with an empty space saying, what did I pay for? So there will be things I will offer you to try to soothe the impact. But you can see, it's your job as the potential buyer to bring this up, because I'm not going to bring it up. If you just take my stated operating income and pay for it, I'll say, that's fine, let me walk away, because then it becomes your problem. So you will have to do the research to kind of follow up on this, because if you don't do it, it's not going to come up from the other side. So you're going to adjust for, if you can, the key person. Yes? Loss. Well, I'm assuming it flows through, but you could probably go to the revenues and work all the way through, because some of the costs are fixed costs. You're right. It could be just that the effect, in which case the effect is actually going to be much bigger than 20%, right? Because the fixed cost carrying through. But that's actually a good point. You might start with the revenues and work down. I was kind of using a shortcut here, basically taking the 20% off the operating income. Let's not forget valuation. Just because you're valuing a private business doesn't mean everything we've talked about in valuation can be set to the side. In fact, the key thing we've kind of emphasized in public company valuations is growth, return on capital, and reinvestment are linked at the hip. You cannot violate that equation without creating problems in evaluation. So here's the final thing I'm going to do. I'm going to assume a growth rate equal to the inflation rate. You see why I've set it the inflation rate? Because at any growth rate above the inflation rate, I'm going to have a problem. Restaurant's already at full capacity, right? Where am I going to put all these extra people? So if I put a growth rate higher than the inflation rate, it's not undoable, but it becomes a lot messier. I have to be a Wolfgang Puck, right? You know what Wolfgang Puck does, right? He franchises, you go to every airport now, there's a Wolfgang Pucks, which is doable. That's a different business model. I don't want to go there. So I said inflation rate. You're saying, but if I have to just go with the inflation rate, I don't need any reinvestment. That's not true, because reinvestment here is you have to maintain this restaurant, right? Maintaining the restaurant would require that you reinvest some money, some of that earnings back into the restaurant, keeping it looking good, doing whatever you need to do. To estimate how much you need to reinvest, I'm going to let you earn a really high return on capital. Why? Because you're a kind of isolated small business, you're living off your name, that's your brand name, a competitive advantage. I'm going to let you earn a 20% return on capital. What that allows me to do is estimate what your reinvestment rate has to be, so that I can get to my cash flows. Exactly the inputs I need in a traditional valuation. I'm still looking for them in a private company valuation. Okay. So I've got my discount rate, I've got my growth rate, I've got my reinvestment rate. I pull the numbers together in my valuation. Okay. Start with the operating income. In this case, I use the adjusted operating income, 20% lower than that stated operating income, because essentially that's the key person discount applied. Use the tax rate, 40%, 2% growth rate forever, 10% reinvestment rate from the previous page, cost of capital based upon the total beta, not the market beta, because you're not diversified. What I end up with as a value for the entire restaurant is $2.416 million. Before you pay me the money, though, remember this is the value of the entire restaurant. It's not the value of the equity in the restaurant, the value of the entire restaurant. So what else is there? You have that lease that you will now be taking over from me, right? The present value of those lease payments is $0.928 million. Don't forget to subtract that out, because if you pay me $2.416 million, you're going to wake up tomorrow and recognize you actually paid me $3.3 million because you've now taken over the lease. So you subtract out the lease, the present value of the lease. What you end up with, the $1.488 million, is the estimated value of equity in this restaurant that you should be willing to pay me. Yes?
The return on capital, should we use whatever they earned on the time of the property?
Well, I think it's a tough one. I mean, you could use, how do we estimate return on capital for a publicly traded company? We take operating income divided by book capital. You can do that for a private business, just as you do for, so that I think is less driven by having a market number to begin with. So you should be able to compute a return on capital for a private business. Whether they can sustain it is, I think, the tougher issue. So there you have to look at what are our the same things you look at with a publicly traded company. What are the competitive advantages? What am I basing these higher prices and higher margins, higher returns on? Can I keep them going? And it will affect your value. Before you pay this $1.488 million, one final consideration. You pay me $1.488 million, this is now your restaurant, right? You have buyer's remorse, tough luck. There's not a whole lot you can do. You can't turn around and try to sell the restaurant quickly. So the last issue we have to somehow bring into this computation is how is illiquidity going to affect how much you pay? Okay? You're saying, how come we didn't worry about this with publicly traded companies? Well, if you're a liquid publicly traded company, we didn't worry about it because we assumed that if you change your mind, you can sell it. You have to pay, $8.95, whatever, and it's not a big deal. But maybe even with publicly traded companies, we should have worried about it somewhere along the way, right? But you know where it's going to show up? You value a publicly traded company. Let's say you come up with $3 per share. The stock is trading at $2.50. At least that's a listed price. It looks undervalued, right? So you pick up the phone, you call your broker, buy me 1,000 shares of the stock. He says, I'll get back to you, which already tells you that this is not a stock you can look up. So he gets back, he calls around, and he says it'll be $3.25. And he said, what, it's listed at $2.50. So that's the listed price, but there's a huge bid-ask spread on the stock. It's a very illiquid stock, and if you wanted to sell, it will be $1.75. If you want to buy, it's going to be $3.25. The way it's going to show up is when you try to put your valuation into practice as an investor, you're going to find yourself stymied by the fact that the transactions cost and the bid-ask spread. So it's not as if with publicly traded companies we don't worry about the valuation. It's going to manifest itself when you try to decide how much to pay for the stock. But with private businesses, you actually have to be explicit about how to bring in illiquidity in. Right? But let me state a couple of propositions about illiquidity. Even though I accept the fact that private businesses will have an illiquidity discount, I don't accept the proposition that that discount is going to be the same for every private business. That's pretty much common sense, right? It should vary across businesses. It should vary across businesses depending on how large you are as a private business. It would be crazy for me to take Cargill or Coke Industries, huge private businesses, multi-billion-dollar revenues, and knock 25% of the value. That would be $4 billion I leave on the table. It will depend upon what kind of assets you own as a private business. In other words, you're a private business and you hold only marketable securities. Why should there be an illiquidity discount? Because even though your business is not liquid, your assets are liquid, right? I can sell them. It will depend on what assets you own. It will depend on whether you're healthy or unhealthy as a private business. I mean, if you're a healthy private business throwing off a lot of profits and cash flows, it might be easier for me to sell you than if you're an unhealthy private business. So I would expect the discount to vary across private businesses depending on size, depending on health, depending on the type of assets. I would expect the discount to vary across time. You're trying to sell a private business in March of 2009. You're going to be facing a much bigger discount than in March of 2008. You can see why, right? The economy slowed down. There aren't that many potential buyers. So it's going to vary across time depending on the same things that drive your default spreads and your equity risk premiums. It should also vary across buyers. You see why the liquidity discount might be smaller for some buyers than others? I mean, if you're a cash-starved buyer, you might need the cash in 2 weeks. You worry about illiquidity a lot more than if you're a long-term buyer who really has no need for cash. So it'll depend on what company you're valuing, what time you're valuing the company at, and who you're valuing the company for. So that's another dimension. Same company, 6 different buyers, 6 different values, right? I'll give you the standard way in which most private company appraisers come up with this discount, because this is a big issue in private company valuation. They look at 2 sets of studies. The first set of studies look at what are called restricted stock. Restricted stock are stock issued by publicly traded companies where they're allowed to bypass the SEC approval process. Normally, as a publicly traded company, if you issue new stock, you have to go through the SEC approval process. To have prospectus, it takes you weeks, months. These companies are allowed to bypass the approval process. You think this is great. But in return for bypassing the approval process, anybody who gets the stock is not allowed to trade the stock for 1 year after they get the stock. You see why this gives us a great chance to look at what illiquidity, right? Because these are publicly traded companies. You see a stock price. So let's say it's $10. You're an investor. I come and place shares with you and say, hey, by the way, you can't trade these shares for a year. Will you pay me $10? And $10 might be the market price, but since I've restricted you from trading, you might say, well, I'll pay you $9.25, $9.50. And it's public information, so I can see how much you're charging me for not being able to trade for the next year. So appraisers have jumped on and say, let's look at restricted stock. Let's see how much investors are demanding as a discount for not being able to trade. The other set of studies look at IPOs. And here's what they look at. They look at the 3 months prior to the IPO, and they look at transactions between owners of the IPO. And they compare it to the IPO price. So let's say the IPO price is $10. They look to see what price the transaction was at in the 3 months before, and they say that must be an illiquidity discount, because you could have waited 3 months and you'd have had a $10 stock, but because you needed the liquidity, how much you charge? You can already see what they share in common, right? In both cases, there's a public price. Normally, the problem with the liquidity discounts is we know some assets are illiquid, but we cannot estimate how much the discount is because all we observe is the transactions price. We don't have a value to compare to. In these cases, it's the market price you can compare it to. But so in both cases, you're getting the discount out of these samples. So let me give you some insight into what the numbers look like from these studies. Restricted stock studies go back about 35 years. Very first restricted stock studies came out in the 1970s, early 1972, 73, 74. Many of those early studies found huge discounts, 30%, 35%, but they focused on just that number. What's the median discount? So they take a sample of restricted stock, they'd compute the median, and the entire paper, that would be the conclusion. The median discount is 32%, 35%, 37%. Paper over. Bill Silber laughs when he talks about this paper because it's a paper that he really didn't spend a whole lot of time on, but it's one of his most quoted papers. 1990 or 91, Bill takes the same restricted stock. In fact, he looked at the same kinds of restricted stock samples that the others did. But in addition to computing the discount, which he found to be pretty substantial, 30, 35%, he followed up. And here's what he did. He looked at the illiquidity discount by transaction, and he tried to see why the discounts varied, because he found that the discount wasn't 32% for every single restricted stock. There was 15 for some, 45 for others. He actually ran a regression of the size of the discount against how much the revenues of the company making the restricted stock issue were, whether how much the block size was of that restricted, because it was it 3%, was it 15, was it 20, whether the company making the restricted stock issue was making money or losing money to catch the health, and finally he threw in whether the person getting the restricted stock was a customer of the company or not, just to make sure that there wasn't some kind of side transaction going on, that you were willing to pay a higher price for the share in return for a discount on supplies. So this is an extension of the restricted stock studies, but it relates the size of the discount to characteristics of the company. The nice thing now is now you can actually start to see how much revenues matter. When you have 10 million versus 5 million revenues, how much is the restricted stock discount drop? You have a way of quantifying the effect of larger companies should have smaller discounts and smaller ones. It's in there. Basically, he found that healthy companies had restricted stock discounts which were much smaller than unhealthy companies, that larger companies had much smaller liquidity discounts than smaller companies, but he could now give a number on it. So that's the restricted stock studies. You can see them going back in time. Here's the nice thing about the Silber study. Okay? Since I can now quantify the impact of what an extra $1 million in revenues would do to your discount, let's suppose you come to me and you tell me how much revenues you have as a private company. Let's say you have revenues of 10 million, which to me is pretty much, let's say that's my typical firm coming in as a $10 million firm. I'm using a base discount of 25%. That's what I use as my standard discount. So if you're a $10 million revenue firm, I give you the base discount. 25%, I'm done. Let's say the next firm that comes in has $100 million in revenues, much bigger than the base firm. Based on the Silber study, I can look to see what the discount should be for a $100 million firm versus a $10 million firm. And holding all else constant, a $100 million firm should have a discount of about 21%. So the $100 million firm will get a 21% discount instead of a 25% discount. Let's murk up the waters. Let's suppose you are a firm with $300 million in revenues, but you're a money-losing firm. Again, I can go back to the Silber regression, adjust for the size of the revenues and the fact that you're now an unhealthy firm, and you say, hey, you know what? Your discount should be 28%. It would normally have been lower because you're a larger firm, but because you're a money-losing firm, I'd adjust it. So what it allows you to do then is to have a base discount, which you then adjust depending on the size of the firm, depending on the health of the firm. But you're building still off those restricted stock studies, but you're kind of looking at the cross-sectional differences. Okay? Any questions on restricted stock, what they measure, and why we're focusing on it? Here's the other set of studies. This is the IPO discounts. I'll tell you something. I look at the magnitude of these discounts, and I'm convinced there's something wrong with these studies. Because think of what I said. These are studies that look at 3 months prior to the IPO. You and I are co-owners of a company. You try to sell me your share of the company. This looks at the discount you're settling for relative to the eventual IPO price. These studies all seem to say that you would accept a 40% discount for 3 months, which that strikes me as an incredibly large discount, right? If we knew for sure that there was going to be an IPO in 3 months and the price was going to be $10 and you were trying to sell your share to me, would you really settle for $6? I mean, is your opportunity cost that huge? What does it tell you about these studies? What is it we're missing? What these studies did was they took actual IPOs, they took 3 months before the IPO, they looked at the transaction price. So they're not fudging the numbers. The numbers are right. So what must these studies be missing when they come up with these really huge discounts? Is every company that plans to go public actually go public? A lot of companies don't. You know what these studies are missing? They're missing the companies which plan to go public that never did. The reason you accepted a 40% discount is 3 months before the IPO, there might have been uncertainty as to whether the IPO would actually go through. This captures not just illiquidity, but risk, and the fact that there's a sampling bias. You've actually captured firms that went public, when in fact you should have looked at all firms that plan to go public. The only problem is the firms that did not go public would not have had an IPO price to compare it to. But you can't turn around and show me this discount and say that's an illiquidity discount. In fact, this is a problem with both the restricted stock studies and the IPO studies, is they're both small sample studies, and they both are based on strange companies. Let me explain what I mean by strange companies. No healthy company would ever make a restricted stock issue. You know why, right? Because you're giving up, what, 20%, 25%, 30% to place the offering with an investor. No healthy firm's going to do it. So you're going to start out with a sample of relatively unhealthy firms. You're coming up with a discount based on those firms, and you're generalizing to all firms, saying apply a 30% discount to every firm. Same thing with IPOs. No healthy IPO where you're guaranteed that the IPO will go through would you accept a 40% discount 3 months before the IPO. So you have this very strange sampling bias that's pushing up the discounts that you're ending up observing as the actual end numbers of these studies. This is, I think, a classic problem anytime somebody says, well, I got this number by looking at a sample. Rather than focus on the mechanics of what they've done with the sample, ask them how they came up with the sample in the first place, because that's where the problem might be. If you have a biased sample, you're going to get strange results. In the private appraisal business, for 27 years or 28 years, starting in the mid-70s all the way through 2001, they got away with murder. What I mean by that is private appraisers want to use a high illiquidity discount. You know why, right? Because many of these are tax. There's a tax debate. The IRS wants to collect more in taxes, and they want to claim they have a business. So appraisers would use 35, 40, 45% discounts and back it up using these restricted stock studies. So they'd go to the court. And the legal system is very strange in this way. The legal system pays a lot of respect. If people have done this before, precedents, right? If this has been done before, we will continue to allow you to do it. So the longer they did it, the more it fed on itself, because they could point to 25 years of case studies and say, hey, you know what? Look at that case. Look at that case. We all were allowed to put 35% in liquidity discounts. We should be continued to allowed to do that. Until you get to 2001, when in one of these cases between the IRS and a taxpayer, the taxpayer's appraiser came in and used the 35% discount, and the IRS for once actually, rather than being cheap, hired a good appraiser, paid him a lot of money to give the counter. And this appraiser actually took the restricted stock studies and he broke out how much of that discount came from the sampling bias, the fact that he had strange companies, and how much came from illiquidity. And the 35% number? He concluded that 10% of that came from illiquidity and 25% came from the sampling bias. The way he separated it out is he looked at all private placements and he compared that to restricted stock issues, and he said, you know what, this is a sampling bias. 10% is the liquidity discount, 25% is just sampling bias. So the court now had two numbers. 35% was the appraiser's number, 10% was the IRS, and the court couldn't say throw it out because the guy had done a lot of work. He had statistics come out of the wazoo. The judge had no idea what a T statistic was, so he wasn't going to say that T statistic looks bad. So you have 35 and 10. What does the legal system usually do? It splits the difference. It's a stupid system because it begs to be played, right? Because you know exactly how the game is played. You're going to play for that middle. And they said, well, we don't want to make either side too unhappy, so we're going to go with 22.5%, which left the IRS delirious with joy because they always got the 35% discount up to then, and appraisers for private businesses quaking. I mean, for the next 3 years, this is the only thing they ever talked about. I refused to actually go to private appraiser conferences because all they talked about was illiquidity, 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 all day long, all night long, next day, next night. No matter what topic you brought up, they said, what are the implications for illiquidity? You could be talking about equity risk premiums. Could I use a higher equity risk premium to reflect illiquidity? I mean, basically, they were looking for every possible way they could slip it in. But you could see this coming. You start with bad samples, you draw conclusions, and it's going to catch up with you sooner or later. Which, of course, then opened me up to the critique, because I've made this point for a long time. You can't use these discounts. What are you going to use instead? So I fell back on the mechanism I talked about at the start of this class. I said, there's an illiquidity discount with every publicly traded asset. It's called the bid-ask spread. If I define that to be the illiquidity discount, what's the size of my sample? Every publicly traded stock has a bid-ask spread, right? There are 10,000 publicly traded stocks in the US. I have a sample of 10,000. You can't accuse me of sampling bias if I'm taking every publicly traded stock. What if I define the bid-ask spread as a percentage of the price as the illiquidity discount in a publicly traded company? Okay? I can't just look at the size of the spread because it's a dollar value, but if I divide by the price, it's a measure. So if you take a stock like IBM, the spread is a tenth of a dollar, 10 cents. Stock price is 80, 10 cents divided by 80, the discount is almost nothing, right? 1%. You take a small company, the company that I gave you, $2.50 stock price, 75-cent bid-ask spread, or $1.50 bid-ask, you could end up with a discount of 45, 50, 55%. So I got that for every publicly traded stock in the US. Then I looked up variables that I could also find for private businesses. That was critical because you need something that you can access for. So I ran the regression of bid-ask spreads against the revenues of the publicly traded company, just to get see the effect of the size of the company on illiquidity, whether the company made money, kind of imitating what Bill had done with restricted stock, how much cash the company had. You see why I looked at cash? What should the liquidity discount on cash be? It's cash. I don't care. It's private or public. So if you have a lot of cash, in fact, I would have liked to use liquid assets, but then I'd have run into a problem trying to define liquid assets. And then I threw in a variable that you're saying you're not going to get for a private business. I threw in the trading volume. So I got a regression of bid-ask spreads across publicly traded companies. You come to me with a private business. You know what I'm going to do? I'm going to ask for your revenues. I'm going to plug them in. I'm going to ask you, did you make money last year? If it's positive, I'm going to plug that in. I'm going to ask you how much cash you have. Plug that in. I'm not even going to ask you what your trading volume was because I know exactly what it was, right? I'm going to put in 0. I'm going to act like you're a publicly traded company that never trades. Yeah, what's to stop me from doing it? I put in 0 as a trading volume. I get a predicted bid-ask spread for your company. I'm going to argue that's an extension of the illiquidity discount from the public domain into private businesses. Will it give me a different answer? Let me show you actually the discount I got for this restaurant using all the approaches. If I use what I call the bludgeon approach, take a fixed amount, knock it off every company, I'm going to be taking 25% off because that's still the standard in private company appraisals. Which means I'm going to take 1.488 million, knock 25% off. 1.488 million was the original DCF value I came up with for the equity, which will give me a value of 1.116. If I use the silver regression, because your revenues are tiny, you're a $1.2 million revenue restaurant, my discount will actually be higher because in the silver regression, the smaller the revenues, the bigger the discount will have inflated out to 28%. But those two are both based on the restricted stock studies and the discounts from those. If I plug the values of the revenue, the fact that you're making money in a restaurant, how much cash you have available on your balance sheet, the fact that you never trade, I get a predicted bid-ask spread for your business of 12.88%. To me, that's an estimate of the illiquidity discount for your restaurant. I knock 12.88% off. The value that I get for the equity is 1.296 million. This is a very raw regression. You can already see there are lots of things you can do with this bid-ask spread regression that will give you much more precise estimates of the liquidity discount. But my point is we need to expand our sample. We can't think of private businesses as liquid, publicly traded companies as liquid, because it's a continuum. You go from very illiquid to almost completely liquid, but nothing is ever totally liquid. There's always some transactions cost involved, and you're trying to see how does the market price it. Advantage of regression is as you run it, it'll reflect the market. Today, if I ran this regression, the spreads are all going to be much larger across the board for illiquid stocks. You're going to capture it in your regression. It's going to capture the time. It's going to capture the factors you have to worry about. And it'll also give you a much larger sample on which to base your discounts. Any questions? So in a sense, you can already see it's a lot more work valuing private to private transactions, which is why it's such a big business, right? It's much more difficult to put this in autopilot because there are dimensions that have to be specific to this company and this transaction that you have to bring in valuing this business. Any questions on private to private transactions? If any of you have relatives, friends who own private businesses, think through this process because it'll force you to think about some of the mechanics of valuation and make a huge difference to somebody who's going to be paying a fee to somebody else to get often a very approximate value. Offer to take a look at the valuations. You have the ammunition to kind of do the valuation yourself if you have the time. Give it a shot. I mean, it really is worth the effort. Let's take the second. So now things are going to get easier because the next two sets of transactions, things are going to look closer to what we did with public companies. I'm going to look at what's going to be different if you have a private business being sold not to another private individual but to a public company. You know what the biggest difference is going to be? Public company looks at the risk in this private business. They don't look at total beta because their investors are diversified. They can go back to a public beta. In fact, that's all I'm going to do. I'm going to go back to the restaurant valuation, and instead of using the total beta, I'm going to revert back to a market beta, which gives me a lower beta, lower cost of capital. You can already see what's going to happen, right? Same cash flow, same reinvestment rate, same return on capital, same growth rate, lower cost of capital. The value that I'm going to get for the business, instead of being 1.3 billion, which is what I got for the private business, is going to be 3.088 for two reasons. One is the lower beta. The other is, notice that there is no illiquidity discount. How come? Because I can buy and sell shares in the publicly traded company whenever I want. I don't buy and sell assets of a publicly traded company. The fact that the asset itself is illiquid is irrelevant if I can slice up the investment into small pieces and buy and sell them. That's a big difference in values, right? So if I'm the owner of this restaurant, I can sell it to you, the investment banker, for 1.3 million. Or I can sell it to ARC Restaurants, publicly traded chain, for 3.1 million. This is a no-brainer, right? If you two compete for my company, you know what's going to happen, who's going to win. It's in fact the answer to the question, how come so many private businesses end up in public hands? Because if you have two competing bidders, the publicly traded company starts off with an incredible advantage over the private bidder And it's the reason the Yankees almost ended up being part of Cablevision. Right? Because no private buyer, it's the reason the Dodgers ended up with News Corp for a while, is no private buyer can compete with a public buyer not because they're not more efficient, but because they look at the same firm and they see far more risk in the same firm. Okay. So let's say you're the public company. You come up with a value of $3 million. I'm the private owner of this restaurant. I can see the $3 million, so I've worked out the numbers. So when I try to ask a price of you, I know who you are, I know that you're diverse, I know your investors are diversified. You can see that if these two numbers in front of me, 1.296 million, which is a private-to-private valuation, 3.0. Which one should I ask for? No brainer, right? Of course I should ask for the 3. Am I likely to get it? What are you going to claim on the other side? You're going to claim to see every risk under the sun, right? You're going to act like a private buyer because it's in your best advantage to act like a private buyer. And if I make too much of a fuss, what are you going to threaten to do? You're going to threaten to get up off the table and walk away. Which is the reason if I'm the seller of this restaurant, I want to try to get at least 2 public buyers interested in me, because then I can play you off each other. But if there's only one public buyer in the game and everybody else is private, you can already see the incredible advantage you bring to the table. And here's the advantage. You can pay me $1.5 million. I'm happy, right? I'm making more than in a private-to-private transaction. But it's half what you should be paying. The rest is pure surplus for you. If you're going to build up a company through acquisitions, here's one strategy you could adopt. You can get into a business. There are a lot of private businesses out there. Buy the private businesses at a premium on the private-to-private transaction, but at a discount on your estimated value, and build yourself up as a company. That's how Blockbuster was built up, as a video company. They went around the country buying up video rental stores, which used to be private businesses then, paying a premium on what the going price was, but a discount on what their estimated value was, because they could approach the same transactions as publicly traded investors. So private to public, and you can, and in fact the question that we addressed earlier, if you're a private equity or a venture capital fund, you can already see you're going to fall somewhere in the middle, somewhere between the purely undiversified investor and the purely diversified investor. You're going to fall in the middle. And there again, you can get a competitive advantage if you can move closer towards a diversified investor part. Okay? But then you got to hope that this game doesn't become too competitive, because if it gets competitive, the price is going to get pushed up towards the $3 million. And if you're going to pay $3.089 million, that's it. You've given away the surplus. Yes, Luis?
You put in that here the control premium, right?
No, control premiums actually make no sense, right? What's a premium for control?
You can manage the operations and say that.
You can manage the operations better than the existing people. So unless you feel that you can run this restaurant better than the existing chef, don't pay a control premium. Okay? So if I take the $3.089 million,
But in the Blockbuster case, I see a lot of
premiums over the private company valuation, not a control premium, right? What it is actually is a premium to make you feel good. It basically drives away every other private transaction, private buyer, private seller from this process, or private buyer from this process. It allows me to pay a premium, make you happy as a potential. But it's not a control premium. It's actually a discount on my estimated value. The notion of a control premium is I have to take a market price. And so control premiums are often more in the context of public transactions. And we'll come back and talk, because I think it's a horrible practice. Generally, take a market price and add 20% to say, that's what other people are paying, that's what I'm paying. Because where's the cash flow to back this up? So we'll talk about when control premiums make sense and when they don't in the context of acquisitions. But here we're actually estimating 2 values and figuring out where to go with those 2 values. Last set of transactions, private company that you plan to take public. Right? Here there are a couple of issues. One is you're opening this company up to investors who can be diversified. That's their problem. If they choose not to be diversified, you should no longer be taking the burden of that problem. Second is the fact that you're going private to public will open you up to corporate governance issues. You will now have to answer different, which can change the way this company is run. And thirdly, there are some information disclosure laws that are going to be different. Your financial statements, in fact, if you're planning to go public, have to be redone using FASB requirements. So when you see the prospectus of a company going public, it actually has to follow the same standards as a publicly traded company. So let's look at the implications. I'm actually going to take a hypothetical company. This is a private, it's actually based on a real company, but I've kind of cooked up the name of the company. This is a software company. It's planning to go public. So you're going to be my investment banker, and I've come to you for some valuation advice. So I plan to go public. I plan to have 10 million shares outstanding, and I want you to estimate the offering price per share that you're going to take the company public at. How do most IPOs, how the transaction set up between the investment banker and an IPO? What does the investment banker agree to do? He agrees to take the, underwrites the issue, basically agrees, and he agrees to deliver a price that he has promised, right? And if he doesn't deliver the price, what does he have to do? It's, he has to buy the shares at that fixed price. Keep that in the back of your mind as you try to decide what price you want to quote to me, right? Because there is a consequence. If you give me too high a price, you're going to end up having to buy those shares. You're probably going to get fired. So there are lots of consequences here. So first step in the process, you have to value the company, right? So you can't come up with a value per share unless you know. So you do a traditional DCF valuation, exactly like you'd value any publicly traded company. So right now, it's not a private business you're valuing. You're valuing a public company with betas, with so this is your estimate of value of equity. So $70 million is your estimated value of equity in this company. So what's the big deal? Divide the 70 by 10 million. I've got $7 per share. But wait. With IPOs, there are two issues you have to deal with. One set of issues are valuation issues, which is when you issue shares, you make a public offering, you have to tell me what you're going to do with the proceeds of that public offering. Because what you do with the proceeds can affect the value per share, and you're going to see in a minute why. Whether, you see what I mean by do with the proceeds? Two things you can do with the proceeds is you can issue the shares, take the cash, and the owners of the business can cash out. The other is you can issue the shares, take the cash, and leave the cash in the business to cover future investment needs. Or you can have some intermediate solution. Okay, so you got to tell me what you're going to do. The second issue I have to worry about is by the time you go public, you've had layers of venture capital you've approached, right? Layer stage 1, stage 2, stage 3. Each of them you promised all kinds of things under the sun. Warrants, options, you can do this, you can do that. You're going to buy stock in the company. You better be aware of what's been promised those venture capitals along the way, because that's going to be out of your equity along the way. So it's like management options magnified, right? Because these guys all have options to do all kinds of stuff, very complex equations that can drain your value. So we have to deal with those two. From a transactional standpoint, one thing you have to deal with when you price is that you have this institutional setup, that if you guarantee a price, you've got to deliver the price. If you don't deliver, it's not a, I'll try my best. You actually have to deliver that price. The second issue is in most cases, investment banks take a company public, and they also do aftermarket support, which means they do other offerings. They try to keep the price up. So you have to worry about not just the initial offering, but what you have to do in the weeks after. So that's going to kind of feed into how you set the price. So let's take this one issue at a time. What is the value of the equity in the company that we came up with on a DCF model? About 70 million, right? When you look at the proceeds that you get from the offering, you have to look at it, the proceeds being taken out. Are they being used to pay down debt? In some cases, if you have existing debt, you might use them to pay down the debt. Are they being held as cash by the company? And how we deal with the value will depend on what happens there. If it's taken out of the firm, you can ignore it. So if you issue 20 million shares, you come up with 150 million, but you take it entirely out of the firm, it's not your firm's equity anymore. So that's in that case, you can just take the value you got from the DCF model, divide by the number of shares, you're done. If it's left in the firm as cash, you have to add the cash on top of that discount. So remember that 70 million we got from the DCF model? You have to add to that the cash from the discount. Might seem like you're double counting, but you know why you have to do it? When you did your DCF model, you projected out reinvestment needs, right? It lowered your cash flows, lowered your value of equity. Now I'm letting you raise the cash to cover those expected reinvestment needs for the next 4 or 5 years. So it's like a bonus. You get the DCF value plus. It's like dealing with cash in a traditional DCF valuation. You add the cash to the operating assets, so you're going to hold on to the cash, you just add the cash on. If you retire debt, the way it's going to show up is through your cost of capital, because the weights of debt, you're not changing the value of the firm, but you're changing the weights of debt and equity, and you could potentially change the cost of capital and the value of the firm. So what you do will depend on what the proceeds. So when you're involved in an IPO, that question has to be asked up front of the owners, which is you're going to issue, how many shares are you going to issue? Remember, most IPOs, not all the shares get issued to the public. How many shares are you going to issue? What are you going to do with the proceeds you get from that cash? So let's take this example. Right? $70 million was their DCF value, right? That came from the original DCF valuation. Let's suppose I told you that 20% of the shares in this company are going to be in Infosoft are going to be issued to the public. 10 million of the proceeds will be held by the firm to cover future investment needs. So they're going to stay in the firm. But the rest is going to be taken out of the firm because the owners want to cash out at least some of the proceeds. 10 million shares outstanding. Estimate the value per share for me. Do you see the question? You have the original DCF value, so you know what the value of the firm is. 20% of the proceeds are going to be, 20% of the equity is going to be issued to the public. 10 million is going to be kept in the firm as a cash balance to cover future reinvestment needs. The rest is going to be taken out. The part that is taken out, we don't care about, right? It doesn't affect our value. The part that's left in the firm, the 10 million, will add on top of the 70 million. So you got 80 million divided by 10 million shares gives you a value per share of $8 per share. Does everybody get what I did? I take the DCF value, I add to that the cash that's left in the firm from the proceeds. That gives me the total value of equity. Divide by the number of shares. You got the value per share. Okay. I sent you that link to IPO Central in the newsletter. I know none of you even look at the newsletter anymore. Go click on that link. There aren't that many IPOs out there right now. It's a particularly dry time for IPOs. But pick up an IPO. Look at the prospectus. It's kind of fun because these are young companies, small companies. They will have to, in the prospectus, specify what they're going to do with the proceeds. It's required. The SEC actually requires companies to say, this is what we plan to do. So look at how much cash is left over. Add it to the DCF value, divide by the number of shares. You got the value of equity. This is assuming there are no options you've been giving along the way, right? If you have options you've been giving along the way to your venture capitalists, guess what you have to do with them? You have to do exactly what we did with management options. You've got to value the options as options, subtract it from the 80 million before you divide by the number of shares. Okay? It's actually very messy when you look at the venture capitalists, the different stages, what they've taken as options. But you have to do that, because if you don't do that, you're going to be surprised by them turning their options into shares 2 months down the road, 6 months, 1 year, 2 years down the road. Any questions on the valuation mechanics? So make sure you keep the proceeds, add them onto your DCF value, make sure you take into account options outstanding. Now let's look at the transactional issues. Investment bankers make a guarantee, right? We've estimated the value per share at $8 per share. So you're my investment banker. Let's say you feel pretty comfortable with the $8 estimate. However, once you make that price guarantee, you're stuck with it. So if anywhere along the way you've screwed up the cash flows and the discount rates, you're going to bear the price. So here's my question. $8 per share, would you set the offering price? So the offering price is the price you're going to send out to the public. Will you set it at $8 per share, or will you set it at a higher number, a lower number? What will you do? Given that you've given me a guarantee on the price, you're going to knock something off the price, right? In fact, investment bankers are not shy about this. You look at there's a manual for every investment banker that they ask you to read. It's not an official manual. Basically, it tells you how to approach this process. It could fit on a page usually. Okay? And if you're working in IPOs, here's what the manual will say. Do your valuation. Then the last note will say, knock 15% off the value. I'm not kidding. It's actually part of the IPO pricing manual. And you can see why, right? I don't blame them, because you giving a guarantee, you're going to get no upside from setting the price too high. You knock the price. Guess what? When you look at IPOs, the typical IPO is underpriced by about 15%. Some are abysmally underpriced, 40%, 50%. In fact, the way investment bankers like to rank themselves is they want to see if they're getting close. If they are pricing IPOs too close to the actual prices. So the way that they come up with this graph is they look at the offering price, they look at what happens on the first day when the market actually gets to trade. On the first day of an IPO trade, you generally see a jump in the stock price of about 10, 15%, some cases 30 or 40%. 15% of IPOs are overpriced. Those are the investment bankers who don't stay around as IPO investment bankers for very long, because you can't keep doing this. You don't have the capital to cover this. Okay? But most cases, IPOs are underpriced, and you can see why. In fact, one thing in finance is they've had this thing about this being a puzzle. I don't know, what's the puzzle here? I mean, I would be puzzled if investment bankers actually priced IPOs at the offering price. You can see exactly why they do it. In fact, the reason I think finance academics get too caught up in this, they think of this as lost wealth to the owners of the company going public. And that seems legitimate, right? When I underprice by 15%, it seems like I'm taking money out of your pocket and transferring it to the investors. But even that is a fairly shaky argument, and here's why. Right? Let's start on the other side. Let's say you're an investor. You see this graph. You see a typically underpriced by 10 to 15%, right? Does this look like a money machine that you could exploit? So what's your strategy going to be? You're going to start a mutual fund. What are you going to do with this mutual fund? You're going to apply for 100 shares in every IPO that's going to come out in the next year, right? And you should walk away with this big excess return, right? What's the catch? You apply for 100 shares in an IPO. Will you get 100 shares? The nature of the process, if I underprice, I'm going to get too many people trying to buy the shares. I have to allocate the shares. And if I'm doing it fairly, if you apply for 100 shares, in those IPOs where I've underpriced the most, you might get 60 shares. Where I've underpriced less, you might get 80 shares. The issues where I haven't underpriced at all, you might get 100 shares. And those issues where I've overpriced, no problem. I'll give you 100 shares. I'll offer to sell you more. You see what's going to happen, right? So when you sit down and you tally up your portfolio, you're going to be over-invested in those IPOs that are overpriced. You're going to have far less than you thought you would. And there have been people who've read these academic papers, started mutual funds, and they look at their actual returns and say, what the heck happened here? How come I'm not making a 15% excess return? Here's why. So as an investor, you can already see that it's not easy to exploit because there are IPOs that are overpriced, and those are the IPOs that are going to be disproportionately in your portfolio because you get every share you want. So let's look at the other side. Is this unfair to the owners? You be the owner of the private business. I'm your investment banker. If you're planning to sell 100% of your shares, you can see why you'd be upset, right? If I underpriced by 15%, I've knocked off 10.5, 11, 15 million off your value. But in most IPOs, as I said, owners don't sell 100%. They sell 10, 15% upfront. In fact, in most IPOs, the owner's big sales come 2 years, a year and a half, 2.5 years after the IPO. Now, will that alter how you think about this underpricing? You see, if you see an IPO that's underpriced, what's the headline on the Wall Street Journal the next day? Stock jumps on public offering, right? This is like a, you know how department stores have these loss leaders up front? Where all this stuff, they sell it below cost. You walk in tables and tables of useless stuff selling at half the price. Many IPOs, you can actually argue that owners, their initial public offering, viewed as a loss leader. They want the news, they want to get publicity, and what they really hope to do is ride that publicity 6 months, a year and a half down, and use it to sell the rest of their offerings. Which means owners are not as upset as academics are about this discount. They can live with it. It's not the end of the world for them. In fact, I would argue there are some owners who would be very upset if on the first day of the public offering, their stock price dropped 20%. They might have got some extra money from the offering. But they have a lot of bad publicity that they now have to live with for their subsequent offerings. Yeah.
Yeah, but I mean, if you see this transaction, isn't that a risk-free for the owner, and there's a risk that's involved?
Nothing is risk-free, right? Where is it risk-free?
Because, you know, I know DCA valuation is a long-term thing. Now, what's the guarantee that, you know, when you put up the stock?
But it's, you discounted at a risk-adjusted rate. Don't ask for another risk adjustment after you've done it. Right? The $8 is based on the risk-adjusted rate. So you could say that about any value you come up with. Right? The value you come up with is a risk-adjusted value. You cannot use it as a justification for knocking another 15% off the value. That will be double counting the risk. If you use the risk-free rate as your discount rate, I'll agree with you. You adjust it for risk, you charge a higher risk premium, you have a higher cost of capital. It's all built in. Why are we knocking an extra 15%?
But if, you know, if you're going to go IPO 3 months down the road, the market tanks. That's a
You don't set the offering price 3 months before the offering. You set it, these days, you set it 3 days or 2 days. I mean, the lead time between there is no time risk involved anymore, right? So that's why you wait till the very last moment to set the offering price. So this is not a 3-month risk transaction you're in. I mean, that's why investment bankers, when they make their initial, when you bid for them, they don't give you the offering price up front and wait 3 months. This happens at the very last moment to minimize any price risk. Okay? So from the perspective of the investment banker, the risk actually of overpricing is very small. But it's still, because their capital is so large, it's catastrophic when they do. So they've got to build it. And so I can understand why they do it. I can understand why owners go along with it. So to me, there's no puzzle. It's a reality of how companies get priced for their initial public offering. So final points about private company valuation. If you're a private business owner and you're looking for a potential buyer, here's what you want to look for. You want to look for an investor who's long-term. You see why that matters? Because he's going to charge you a lower liquidity discount than a short-term investor. You want a well-diversified buyer because they're going to base it on the market beta. And you also want to get a buyer who thinks you're useless. In fact, often I'm a terrible business person because, you see why this matters? The key person discount then is going to be tiny because I can replace this guy. Let him worry about it afterwards. So you want somebody who doesn't think too highly of you, is diversified, and is long-term. Sell him the company and then let him worry about whether he thought too highly of you. So maybe this is why Asians like the strategy of I'm a really bad business person. Maybe this is the Japanese strategy for getting people to actually have a small key person discount, is to have that humility up front. No, I don't know how I built up this business, a pure accident. No, pay me the premium and then I'll get a little ego going. But first, let me get the money out of you, right? So factor that in when you think about private company valuation. It's a lot of fun to actually value private business. It's much more fun to me than publicly traded companies. If you get a chance, try your hand out at it.